For the last 2 years, investing was easy. You parked your cash in a 3-month T-bill or a high-yield savings account, earned a sweet 5% risk-free, and went to sleep. It was the perfect setup. But that party is ending. As we head into 2026, the Federal Reserve is signaling rate cuts, and something huge has just happened in the bond market. The yield curve has officially deinverted. What does that mean? The 3-month T-bill yield, that safe haven you've been enjoying, has now dropped below the 10-year Treasury yield. This creates a massive problem for your cash, and it's called reinvestment risk. As your short-term T-bills mature, you can't just roll them over and get that 5% anymore. Now, you're renewing them at 3.5%, and soon, maybe 3%, or even lower. So, the big question is, where do you put that money now to protect your returns? Let's break down what just happened. This is a classic bull steepening. The Fed is cutting its short-term interest rates to support the economy, which is pulling down that 3-month T-bill yield really fast. Meanwhile, the 10-year yield is holding steady, or maybe even rising a bit, because the market is still thinking about long-term growth and inflation. Now, here's the crucial warning. History tells us that this flip, when the curve deinverts, often happens right before a recession. This single fact dictates our entire strategy. We need to play defense, but we also need to move quickly to lock in good yields before they disappear entirely. So, let's talk strategy. First, we need to fix the cash drag on your portfolio. The simplest move is to extend your duration. Think about it. If a recession does hit later in 2026, the Fed will likely cut rates even more aggressively. That 3.6% you might be getting in your savings account could easily drop to 2% or less. Here's the actionable step. Stop rolling over all your cash into 3-month bills. It's time to look further out. Consider locking in the 10-year Treasury yield, which is currently around 4.2%, or maybe the 5-year. By doing this, you are securing that interest rate for 5 or 10 years, no matter what the Fed does next year. Plus, there's a bonus. If a recession causes interest rates to crash, the price of your longer-term bonds will actually go up. This means you get your steady yield, plus potential profit on the bond's price. It's a win-win in a falling rate environment. Next, what about the stock market? It's a tricky picture right now. If we get a soft landing, growth stocks and tech could fly. But if we get a hard landing recession, almost everything could drop. So, how do you position yourself? The answer is a barbell strategy. On one end of the barbell, you want to be defensive. This means allocating a portion of your portfolio to sectors that do well when the economy slows down, like utilities, consumer staples, and healthcare. These companies sell things people need no matter what, and they often pay reliable dividends, acting almost like a bond. On the other end of the barbell, you stick with quality growth. I'm talking about companies with massive cash piles and strong balance sheets, like the big tech giants. You want to avoid small-cap stocks or highly leveraged companies that rely on cheap debt. Those are the ones that often get squeezed the hardest when credit tightens during this lag phase. Finally, let's add an insurance policy. Historically, when the yield curve deinverts and the Fed starts cutting rates, the US dollar tends to weaken. This environment is typically very bullish for gold. Holding a small position in gold can act as a buffer. And don't forget the power of cash. Even at a lower interest rate, you want to keep some cash on the sidelines for optionality. If the market does crash 20%, you'll have the liquidity ready to buy great companies at a discount. So, to wrap it all up, the do-nothing era of earning 5% on your cash is over. You have to be active now. Don't just let your cash sit in accounts with dropping rates. Look at extending your duration by buying longer-term bonds to lock in yield. Rotate your stock portfolio into a barbell of defensive and quality growth names, and consider a small allocation to gold or a cash buffer for insurance. The free lunch is over, but with the right moves, you can navigate this new environment successfully. What's your plan? Are you locking in rates, or are you riding the T-bill wave down? Let me know your thoughts in the comments below. Thanks for watching, and I'll see you in the next video.